An ETF, index, or mutual fund, which is the best option for you and why? What would a smart investor choose? Hey champs, welcome to the MoneyMind Quest, your GPS for navigating and mastering personal finance. If you're all about making smart financial decisions, you're in the right place. Be sure to watch this video till the end and join the MoneyMind Quest champs by smashing that subscribe button. Take the financial literacy test at the end of this video to improve your financial skills. Stick around and get ready to build wealth. Let's roll. Today, we're exploring the ultimate guide to building wealth through ETFs, mutual funds, and index funds. We'll define each, compare their pros and cons, and share unconventional insights, and discuss the risks and baby steps to get started. Let's jump right in. First, let's define these investment vehicles. Exchange-traded funds, ETFs, these are investment funds traded on stock exchanges, much like individual stocks. Think of ETFs as baskets filled with different types of investments like stocks, bonds, or commodities. You can buy and sell shares of these baskets on the stock market, just like you would with individual stocks. They help you diversify your investments without needing to buy each stock or bond separately, and usually come with lower fees than other funds. They aim to track an index or sector. Mutual funds, think of a mutual fund as a big pot where many investors put their money together. Professional managers then use this money to buy a mix of stocks, bonds, or other investments. Mutual funds come in different types depending on what they invest in, like stocks, bonds, or even a mix of both. These funds are priced once a day. Some mutual funds are actively managed, meaning experts decide what to buy and sell, while others simply follow a market index and are managed passively. Index funds. These are a type of mutual fund or ETF designed to replicate the performance of a specific index like the S&P 500. They provide broad market exposure and usually have lower fees because they are passively managed. Let's say you want to invest in the stock market, but you're not sure which individual stocks to pick. You hear about the S&P 500 index, which includes 500 of the largest companies in the US. Instead of buying shares of all 500 companies separately, you can buy shares of an S&P 500 index fund. By doing this, you own a small piece of all 500 companies in the index, all through one single investment. So imagine index fund as a fruit basket. Each piece of fruit represents a different company's stock. When you buy the basket, you get a bit of every fruit in it. If the overall quality of the basket improves, your investment grows. If the quality drops, your investment value decreases too. This way, you're spreading your risk across many companies instead of relying on just one. Index funds are known for their low cost because they don't require a lot of management. They simply mirror the performance of the index they track. Now, let's compare these three. ETFs are traded like stocks. They provide a versatile and tax-efficient investment choice. Unlike mutual funds, which can only be bought and sold at the end of the trading day at their net asset value, ETFs are traded on the stock market throughout the day, allowing for real-time price changes. ETFs generally have lower expense ratios compared to actively managed mutual funds and are often more tax-efficient due to the unique in-kind creation and redemption process. This process involves trading securities for ETF shares directly, which helps reduce capital gains distributions and consequently tax liabilities for investors. While index funds also aim to replicate market indexes and typically offer low costs, ETFs excel in tax efficiency and trading flexibility. This combination of lower expenses, favorable tax treatment, and the ability to trade during market hours makes ETFs an appealing option for many investors. Mutual funds are pooled investment vehicles managed by professionals who allocate the funds into a diversified portfolio of stocks, bonds, or other assets. Unlike ETFs, mutual funds are priced only once at the end of the trading day based on their net asset value. While both mutual funds and index funds offer diversification, mutual funds can be actively managed, with fund managers making strategic investment decisions, which can lead to higher expense ratios compared to the typically passive and low-cost index funds. Unlike ETFs, mutual funds are less tax efficient due to more frequent trading within the fund, potentially generating higher capital gains distributions. Despite higher costs and tax implications, mutual funds provide professional management and a wide range of investment strategies, making them suitable for investors seeking hands-off management. Index funds are investment funds designed to replicate the performance of a specific market index, like the S&P 500. They offer low-cost, passive investing, as they don't require active management. Compared to ETFs, which also track indexes but trade like stocks throughout the day, index funds are priced only once daily at their net asset value. While both index funds and mutual funds offer diversification, index funds generally have lower expense ratios due to their passive management approach. Unlike mutual funds, index funds are more tax efficient as they have lower turnover and generate fewer capital gains. This simplicity and cost effectiveness make index funds a great choice for long-term investors seeking broad market exposure without the need for active management. Here's a quick rundown of the pros and cons. Let's start with ETFs. They offer some awesome perks like flexibility and real-time pricing. You can trade them anytime the market is open. They're tax efficient because they minimize capital gains taxes due to their unique structure. Plus, they usually have lower expense ratios, meaning you pay less in management fees compared to mutual funds. But there are a few downsides. You'll need to watch out for trading costs and the temptation to overtrade. Also, they often have less professional management than mutual funds. So it's all about balancing the benefits with the potential drawbacks. With mutual funds, one of the biggest perks is professional management. You've got experts handling your investments. They also offer great diversification, spreading your money across a variety of assets to reduce risk. Plus, they're pretty straightforward, making them a simple choice for many investors. However, there are some downsides. Mutual funds often come with higher fees due to active management. They can also be less tax efficient since the fund managers frequently buy and sell assets. Lastly, they often have minimum investment requirements, which can be a barrier for some folks. So weigh these pros and cons to see if mutual funds are right for you. Let's talk about index funds. They're great because they have much lower fees since they're passively managed. You get broad market exposure, which means your investment is spread across many stocks in an index, reducing risk. They're also really simple, just track the index without needing to pick individual stocks. On the flip side, you're limited to the performance of the index, so if the market isn't doing well, neither is your fund. Plus, they lack the flexibility of more actively managed investments. So while they're a solid, low-cost option, they do come with some limitations. So how do these investment options help your personal finance? ETFs, mutual funds, and index funds all offer diversification, reducing risk by spreading investments across multiple assets. They provide accessible ways for investors to participate in the stock market without needing to pick individual stocks. Remember to take the financial literacy test at the end of this video to improve your financial skills, insights, and things to avoid. For ETFs, look for those with low expense ratios and high liquidity to minimize costs and ensure you can buy and sell easily. Avoid niche ETFs with low trading volumes as they can be more volatile. For mutual funds, research the fund manager's track record. Consistency of performance over the years is a good guide. Avoid funds with high fees that can eat into your returns. With index funds, stick to well-known indices like the SP 500. Avoid lesser-known indices that might not offer the same level of stability and growth potential. Ready to start? Here are the steps. Set your goals, review your circumstances, then define your investment goals clearly. Determine if it is for retirement, education, or wealth building. Assess risk tolerance. Understand how much risk you're able to take. Open an account. To do this, choose a reputable brokerage or investment platform by comparing fees, features, and customer reviews. Research and select funds. Based on your goals and risk tolerance, pick suitable ETFs, mutual funds, or index funds. Invest regularly. Start with small, regular investments to take advantage of dollar cost averaging. Dollar cost averaging involves regularly investing a fixed amount of money into a particular fund or stock, regardless of its price, to reduce the impact of market volatility and take advantage of lower prices over time. Leveraging AI intelligence can significantly improve your investment strategy. AI tools process large data sets, spot patterns, and offer insights that may escape a human investor. Use services like Betterment and Wealthfront for tailored investment advice and automated portfolio management. Platforms such as Morningstar and Seeking Alpha also offer in-depth analysis and ratings to help you make better informed decisions. It's essential not to depend entirely on these tools. AI can sometimes misread data or overlook unforeseen market shifts, potentially leading to suboptimal investment choices. The most effective strategy is to use AI to complement your own research and judgment. Continually educate yourself about the market, stay informed with reliable financial news, and seek advice from financial professionals when needed. This balanced approach allows you to harness the power of AI while maintaining control over your investment decisions. Let's talk taxes. As stated before, ETFs and index funds generally offer more tax efficiency than mutual funds due to their structure. Be aware of capital gains taxes. Consult a tax advisor in your local area to better optimize your tax strategy. Remember, all three of these investment vehicles don't offer credit or protection, so diversify your investments to manage risk. Diversification is crucial. Spread your investments across various sectors and asset classes to minimize risk. Understand that all investments come with risks, including market volatility and economic downturns. So keep educating yourself and stay updated on market trends. Be sure to take the financial literacy test at the end of this video. Here are some keys to successful trading. Maintain discipline, stick to your strategy, and avoid emotional decisions. Use stop-loss orders. A stop-loss order automatically sells a security when it reaches a specified price, helping to protect investors from significant losses. Regularly review your portfolio. Make adjustments based on performance and changing goals. So what's the takeaway? If you like real-time trading and tax efficiency, ETFs could be your best bet. If you prefer professional management and don't mind higher fees, mutual funds might suit you. If you want low cost and broad market exposure with minimal hassle, index funds are a solid choice. Remember, the key is to match the investment type to your personal financial goals and risk tolerance. That's the best way to make smart financial decisions. Before investing, ensure you have a solid financial foundation, build an emergency fund, pay off high interest debts, understand your risk tolerance, and clearly define investment goals. This foundation is essential for long-term success. By understanding these options and building a solid foundation, you're on your way to financial freedom. Now, take the financial literacy test in the description below to improve your skills, and smash that subscribe button to join the MoneyMind Quest Champs for more insights on mastering personal finance. Check out this video for some cool tips. Until next time.